No matter where you are today, whatever your age, salary, or family size, if you want to build a better financial future, then you need to invest. We believe everyone can benefit from a comprehensive investing strategy. Here is the basic rule for investments. To get higher returns, you must take higher risk. Some investments are more conservative, while others are riskier in pursuit of higher gains. In order to figure out the right investment mix for you, we need to know how much risk can you afford to take and willing to take. This is your risk profile. Oops, risk detected. We need to figure out your risk profile. The Risk Profile Questionnaire is a discovery process to match your preferences and goals to create your allocation plan. You'll be asked questions on your investment time horizon, your investment goals, your attitude towards risk, and your personal situation, whether you experience novice investor or really tight with cash. Here is a look at a sample risk profile questionnaire. You answer the questions and you add up the points. Then you go and see what type of investor you are. Recommended portfolios. Depending on what you score, you might be offered a conservative allocation, mostly cash, a moderate allocation, more bonds than equity, balanced, slightly higher in equity, or aggressive, mostly equity. If you have more equity, you're expected to hold on to it longer in order to ride out short-term volatility. Here is a list of asset classes ranked by their volatility or risk level. In general, money market bonds are safer than equity. Large caps are bigger companies, hence safer than small caps. International is riskier because of size and currency risk. You can also invest in tech, commodities, and real estate, but they are higher in risk. This chart illustrates the return distribution of some major asset classes. The orange is last year's return, the blue is typical return, and the gray reflects historical range. Under the blue, if you don't want to lose money, you hold cash or US bonds. For a loss under 10%, you have high yield in US equity. After that, everything is high risk. To devise an optimal portfolio, you need to consider asset allocation. Determine your goals and risk tolerance, then select asset classes accordingly. Diversification. Elect asset classes that don't move together so the good can cancel out the bad without sacrificing overall return. Rebalancing. Rebalance back to start if allocation drifts over time. Risk management strategies. Time diversification. Basically reversion back to the mean, waiting it out. Avoid timing entry points. Consider dollar cost averaging. Flight to safety. US Treasury, gold, inflation, real estate, commodities, tips, exotic strategies, calls, puts. If you think this is too hard, you can always consider to work with an advisor. Or you can pick target date retirement funds, which is a set of funds that automatically adjust for risk when you get closer to retirement. Or professionally managed risk-based portfolios. Find one that matches your risk from your risk profile questionnaire. Here are some typical questions and suggested answers. If you have a short-term horizon, go low risk. If you can't afford to lose, downgrade your risk. Only invest in what you can afford to lose. Not too worried about money? Take out what you need and invest what you don't need for growth. Young but don't like to lose? Improve knowledge, step up risk. We are about to finish, but here's some more for those who really want to challenge themselves. Here is a more complete list of asset classes. Besides large, mid, and small cap, you also have growth and value. There are many different types of bonds depending on the duration, credit, whether they're government, corporate, and international. There are target dates and risk-based funds, sector funds, index funds, and quantitatively driven model funds. Here's an example in correlation. Investment 1 is commodities. All the boxes under 1 are gray, meaning it has low correlation with all other asset classes. The dark blues are highly correlated. For example, 4 and 9, large cap growth and technology, 6 and 8, mid cap blend, and small cap value. These asset classes go up and down together. Here is a growth chart on certain investments in the last 10 years. Technology hit a low point in 2008 but has really recovered, whereas commodities, although doing extremely well now, is still negative from 10 years ago. This chart shows how asset classes go up and down and how reversion back to the mean works over the long haul. So don't panic. Here are some terminologies. Beta is the measurement of the market risk. Standard deviation is the individual investment's risk. Upside and downside capture is how much the stock can capture in a good and bad market. Sortino ratio is a measurement of downside risk only. Alpha and Sharpe are measurements of excess return. Here are some more specific investment risks. Since it's pretty technical, we're not going to cover it. I'd like to suggest if you're really interested, please do read up on them when you have time. Thank you for attending. We've covered a lot. Please do contact us if you're interested in our Riskalyze tool, a risk optimization tool for portfolio selection. Thank you again and hope to hear from you soon.